Picture this. You walk into your local grocery store, and that cart of essentials that cost you $80 last year now rings up at $95 your gas tank. Another painful reminder every single week. This is the reality of inflation eating away at your purchasing power in 2025. But here's the thing. While inflation destroys wealth for some, it creates opportunity for others. Today, I'm breaking down 5 exchange-traded funds that don't just survive inflation, they actually thrive in it. We're talking real numbers here. One fund delivered over 40% returns in the past year. Another manages a staggering $137 billion in assets, and we'll reveal which one pays you over 5% in dividends annually. By the end of this video, you'll know exactly how to shield your portfolio from inflation's silent attack. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let's set the stage. As we navigate through November 2025, inflation remains the elephant in the room. The Federal Reserve keeps dancing around rate decisions. Geopolitical tensions are spiking commodity prices, and construction costs have exploded. Steel is up 125% since 2020. Meanwhile, your traditional 60-40 portfolio of stocks and bonds? It's getting hammered. This is where inflation hedging assets become your financial life raft. Today we're exploring 3 proven strategies. Treasury inflation-protected securities that automatically adjust with rising prices. Physical gold that's been humanity's store of value for 5,000 years. And diversified commodities that capture everything from crude oil to corn futures. These aren't theoretical concepts. These are battle-tested funds managing billions in real investor capital. Let's start with the reliable workhorse. SCHP, the Schwab US TIPS ETF. Imagine having a bond that automatically increases its value as inflation rises. That's exactly what Treasury inflation-protected securities do, and SCHP holds 50 of them. This fund manages $14.56 billion in assets, making it one of the largest dedicated inflation protection vehicles available to everyday investors. Here's what makes it special. Schwab charges just 0.03% in annual fees. That means for every $10,000 you invest, you're paying just $3 annually. Compare that to actively managed funds charging 1% or more, and you're keeping an extra $97 every year working for you instead of going to management fees. But the real magic is in the income. SCHP currently yields 4.84% based on its 30-day SEC yield. Let me put that in perspective. If you invested $50,000 in SCHP, you'd be collecting roughly $2,420 in annual income, paid monthly. That's $200 hitting your account every single month like clockwork. The fund just paid 9.17 cents per share in November, 8.04 cents in October, and 9.9 cents in September. This isn't hypothetical. This is real cash flow. And here's the kicker. Year-to-date through mid-November, SCHP is up 7.2%. So you're getting that juicy 4.84% yield plus capital appreciation, all while your investment automatically adjusts for inflation, because these are TIPS bonds. The portfolio construction is straightforward but powerful. SCHP holds 50 different Treasury inflation-protected securities with a weighted average maturity of 7.32 years. The largest single holding represents just 4.15% of the fund, worth about $604 million. The beauty of this diversification means you're not overly exposed to any single bond maturity. The fund spreads its bets across the yield curve, 25.76% in 1 to 3 year securities, another 25.73% in 3 to 5 year bonds, and the remainder stretched across longer maturities up to 20+ years. Every single holding carries a AA credit rating because they're backed by the full faith and credit of the U.S. Treasury. Zero credit risk, pure inflation protection, monthly income. That's the SCHP. Now let's talk about the Conservative Shield, VTIP, Vanguard's short-term TIPS, ETF. If SCHP is the workhorse, VTIP is the armored tank. This fund is absolutely massive. $62.17 billion in assets under management, making it the largest short-term TIPS fund in the United States. Vanguard matches Schwab's ultra-low expense ratio at 0.03%, so cost isn't a differentiator. What sets VTIP apart is its laser focus on short-term inflation protection with minimal interest rate risk. Here's why that matters. VTIP's average effective duration is just 2.4 years compared to SCHP's 6.6 years. Duration measures how sensitive a bond fund is to interest rate changes. Lower duration means less volatility. When interest rates jump around, VTIP barely flinches while longer duration funds can swing wildly. This fund holds only TIP securities maturing within 0 to 5 years, giving you the purest inflation hedge possible without the roller coaster ride the trade-off. Lower current yield. VTIP's 30-day yield sits at 1.03%, significantly below SCHP's 4.84%, but that's the price of stability. Performance-wise, VTIP delivered 5.77% year-to-date through November 2025. The one-year return matches SCHP at 6.09%. The fund pays monthly distributions, with the most recent ex-dividend date on November 3rd, providing that steady income stream conservative investors crave. VTIP tracks the Bloomberg U.S. TIPS 0 to 5-year index, holding 28 distinct Treasury securities. The top 10 holdings represent 47.53% of total assets, with government bonds comprising 95.55% of the portfolio and cash making up the remaining 4.45%. For investors who want inflation protection but lose sleep over bond volatility, VTIP is your answer. Now let's get to the superstar that's been making headlines: GLD, the SPDR Gold Shares ETF. This is where inflation hedging gets exciting. GLD is the undisputed heavyweight champion of gold ETFs, managing an absolutely staggering $137.06 billion in assets. To put that in perspective, that's more than double the GDP of some countries. This fund has been around since November 2004, giving it a 20-year track record of providing investors direct exposure to physical gold bullion. The performance numbers are jaw-dropping. GLD delivered 26.96% year-to-date through November 2025. But here's where it gets really impressive. The one-year return is 40.8%. Yes, you read that right. 40% in 12 months. The 5-year annualized return sits at 11.46%, crushing traditional bond indices and most equity benchmarks. When inflation fears spike, geopolitical tensions escalate, or currency concerns mount, investors flood into gold, and GLD is where they go. The fund currently trades at $376.96 per share, with gold prices hitting historic highs above $4,000 per ounce earlier this year before pulling back. The net asset value sits at $375.37, meaning the fund trades at just a 0.4% premium to its underlying gold holdings. Incredibly tight tracking for such a massive fund. GLD holds 362.9 million shares outstanding and trades over 10 million shares daily, providing exceptional liquidity if you need to enter or exit positions quickly. Here's what you need to know about GLD's structure. This fund physically holds gold bullion stored in secure London vaults. It's not paper gold, not gold futures, not mining stocks. It's actual physical metal. The trustee cannot lend out the gold, eliminating counterparty risk. 100% of assets are allocated to basic materials in the form of precious metal. But here's the catch. GLD pays absolutely zero dividends. Your returns come purely from gold price appreciation. Plus, there's a tax gotcha. The IRS classifies gold as a collectible, meaning long-term gains are taxed at a maximum rate of 28% instead of the standard 20% capital gains rate. This matters for high-income earners in taxable accounts. The expense ratio is 0.4%, higher than our TIPS funds but reasonable for the world's largest and most liquid gold ETF. When you're moving potentially millions of dollars in and out of positions, GLD's liquidity premium is worth paying. This fund shines brightest during uncertainty, and 2025 has provided plenty of that. Now we come to the commodity twins with very different personalities, PDBC and DBC, both from Invesco. These funds offer broad commodity diversification, but the devil is in the details. Let's start with PDBC, the Invesco Optimum Yield Diversified Commodity Strategy ETF. This fund manages $4.47 billion and takes an actively managed approach to commodity futures investing. It charges 0.59% in expenses, reflecting the complexity of managing commodity futures, roles, and optimization strategies. PDBC trades at $13.66 per share and offers a dividend yield of 4.29%, translating to approximately 57 cents per share annually. Here's what makes PDBC special. It avoids the dreaded K-1 tax form that complicates many commodity investments. The fund achieves this through a Cayman Island subsidiary structure, giving you commodity exposure with straightforward 1099 tax reporting. For investors in taxable accounts, this is huge. The performance shows 1.77% year-to-date and 1.89% over the past year. Modest, but check out the 5-year annualized return of 13.16%. Over longer periods, broad commodity diversification pays off. PDBC invests in 14 different commodity futures, contracts spanning energy like crude oil and natural gas, precious metals including gold and silver, industrial metals such as aluminum and copper, and agricultural commodities covering corn, soybeans, wheat, sugar, cocoa, coffee, and live cattle. This diversification reduces single commodity concentration risk while maintaining meaningful inflation sensitivity. The fund distributes income annually, generated from Treasury securities collateralizing the commodity positions, plus optimization of futures contract selection designed to minimize negative roll yield. Now meet DBC, the Invesco DB Commodity Index Tracking Fund, PDBC's passive sibling. This fund manages $1.04 billion with a 0.87% expense ratio. DBC trades at $22.97 per share, and here's where it gets interesting. DBC offers the highest dividend yield of all 5 ETFs at 5.03%, paying approximately $1.12 per share annually. If you're focused on current income from commodity exposure, DBC delivers. Performance-wise, DBC shows 3.7% year-to-date and 3.92% over 1 year, modestly ahead of PDBC despite being passive. The 5-year annualized return of 13.82% slightly edges out PDBC's 13.16%. Over recent years, the active management edge in PDBC has proven minimal. The big difference: DBC issues K-1 tax forms to shareholders, complicating tax filing for individual investors, but potentially offering slight performance advantages through simpler structure and lower portfolio turnover. DBC tracks the DBIQ Optimum Yield, Diversified Commodity Index Excess Return, using rules-based futures contract selection to minimize contango-driven negative roll yield. The fund rebalances annually every November, providing predictable portfolio refresh cycles. Both PDBC and DBC offer similar commodity exposure. The choice comes down to tax preference. If you're investing in a traditional IRA or 401k where K-1s don't matter, DBC's higher yield is attractive. If you're in a taxable account and want to avoid tax headaches, PDBC's clean 1099 reporting wins. Let's bring this all together with strategic perspective. Looking at year-to-date performance, GLD dominates with 26.96% returns, reflecting gold's safe haven status. SCHP delivers 7.2% with that attractive 4.84% yield and monthly income. VTIP provides 5.77% with lower volatility through shorter duration. DBC generates 3.7% supplemented by that 5.03% dividend yield. PDBC trails at 1.77% year-to-date, though its 5-year track record validates the commodity diversification strategy. For income-focused investors, the dividend comparison tells an important story. DBC leads at 5.03% annual yield, followed closely by SCHP at 4.84%, PDBC at 4.29%, VTIP at 1.03%, and GLD paying nothing. If current cash flow matters, SCHP and DBC emerge as leaders. If pure inflation protection with minimal volatility is the goal, VTIP wins. If you're seeking capital appreciation and don't need income, GLD's 40% one-year return speaks volumes. The market context of November 2025 adds crucial perspective. Inflation remains persistent despite moderating from 2022 peaks. Gold prices experienced dramatic swings, initially surging past $4,000 per ounce before retracing, reflecting uncertainty around Federal Reserve policy and geopolitical developments. Commodity ETFs have seen modest inflows as investors seek diversification, though flows remain concentrated in precious metals rather than broad commodity funds. Construction costs continue rising, with steel up 125% since 2020 and concrete up 15 to 25%, potentially benefiting commodity-focused strategies. Escalating U.S.-China trade tensions with proposed 100% tariffs and Chinese rare earth export restrictions have driven safe haven flows into gold, while creating uncertainty for broader commodity exposures. So what's the bottom line? If you're seeking maximum inflation protection with meaningful dividend income and stability, SCHP emerges as the optimal choice. You're getting ultra-low expenses at 0.03%, substantial asset base of $14.56 billion providing liquidity, high current dividend yield of 4.84%, and monthly income distributions. The fund's broad TIPS exposure and reasonable duration profile balance inflation sensitivity with manageable interest rate risk. VTIP serves investors prioritizing pure inflation protection with minimal duration risk, particularly those uncomfortable with longer-term bond exposure. The ultra-low expense ratio and 2.4-year average duration provide the most direct inflation hedge possible within the ETF universe. GLD serves as the tactical safe haven and inflation hedge for growth-oriented portfolios, with exceptional 2025 performance reflecting its role during uncertainty periods. However, the 0.4% expense ratio and 28% collectibles tax treatment require careful consideration in taxable accounts. PDBC and DBC appeal to investors seeking broad commodity diversification with meaningful dividend income, though limited 2025 performance highlights the challenges of commodity investing during uncertain macroeconomic periods. The distinction between PDBC with active management and no K1 versus DBC with passive indexing and K1 reporting primarily reflects tax and administrative preferences, with minimal performance differentiation over recent years. The beauty of these 5 ETFs is they represent distinct strategies that can work together. A balanced inflation hedging portfolio might include 30% SCHP for income and stability, 20% VTIP for pure short-term protection, 30% GLD for growth and safe haven exposure, and 20% split between PDBC or DBC for commodity diversification. The specific allocation depends on your risk tolerance, income needs, and tax situation. Remember, all data presented comes directly from official fund websites including Schwab, Vanguard, State Street, and Invesco, plus financial sources like Morningstar and ETF Database, ensuring accuracy as of November 2025. These aren't speculative recommendations. These are institutional-grade funds managing billions in real capital with transparent track records. Inflation doesn't have to destroy your portfolio. With the right tools, you can not only protect your wealth but potentially profit from rising prices. The question isn't whether inflation will impact you. It already is. The question is whether you'll take action to protect yourself. These 5 ETFs provide the roadmap. What's your experience with inflation hedging investments? Are you currently holding any of these funds, or are you considering adding them to your portfolio? Drop your thoughts in the comments below. I read every single one and love hearing about your investment strategies. If you found this analysis valuable, smash that like button and subscribe for more data-driven investing content. Remember, this is educational information, not personalized financial advice. Always do your own research and consider consulting with a financial advisor before making investment decisions. Thanks for watching, and I'll see you in the next one.